Ever feel like you're just drowning in the daily noise of the market? Totally lost? Well, you are definitely not alone. Today, we're going to zoom out. I mean, way out. We're going to show you how a simple change in perspective can unlock these huge, powerful stories that have been hiding in your charts all along. So let's dive right in. So, let me just ask you a question, straight up. Are your charts actually hiding the big picture from you? I know it sounds like a trick question, but for most people trying to figure out the markets, the answer is, believe it or not, yes. And here's why. The biggest blind spot for so many of us is this obsession with what's happening right now, the short-term stuff. We get totally glued to our daily charts, right? Staring at maybe 6 or 9 months of data. And what do we see? Every little tick, every little reaction. And it ends up creating this picture that's just, well, it's mostly noise. So what's the fix? How do we break out of that? It's all about gaining a real long-term perspective. We've got to step away from all that daily chaos and start finding some clarity. And we do that with weekly and, even monthly charts. Think about it like this, okay? A daily chart, that's like putting your face right up against a single tree. You're getting lost in every little branch and leaf. The movement feels totally random. But a weekly or monthly chart, that's like taking a big step back and finally seeing the entire forest. Each point on that chart is a whole week or a whole month. All that noise just gets filtered out, and what's left are the real underlying trends, the major price levels that actually matter. And check this out. This right here shows you exactly what I'm talking about. This is a weekly chart of the semiconductor index. I mean, right away you can see this huge multi-year uptrend. It's so clear. Now look right here. See that? The price drop in 1997? It stopped, cold, right at a major support level from a previous low. That is a powerful, powerful insight you would almost never see if you were just stuck in the daily weeds. Okay, so you're probably thinking, this sounds great for stocks, but what about something like futures? Where the contracts are always expiring. How in the world do you build a chart that goes back for years? It's a really good question, a key technical problem, and turns out there's a really clever solution. And that solution is something called a continuation chart. It's brilliant, really, because futures contracts have an expiration date. You can't just track one forever. So what this technique does is it basically stitches together a series of those individual contracts into one long, seamless price history. This is the magic that lets us do this kind of multi-year analysis on markets like commodities. And, there are a few different ways to build them. The simplest way is to just keep linking the nearest contract month after month. But there are also fancier methods, like using contracts that are further out to avoid some of the crazy volatility, or even linking the same calendar month every year to account for seasonal stuff. The big takeaway here is just this. That technical problem, it's been solved. All right, now this is where it gets really fun, because once you have these long-term charts in front of you, you start to see things that are, honestly, they're just astonishing. You start to realize that the market has this incredibly long memory, with patterns that are completely invisible when you're looking at the short term. I mean, just look at this. This is a monthly chart of the Dow Jones. Yeah, at first, it might just look like a bunch of random wiggles, but if you look closer, do you see it? It's a classic head and shoulders bottom pattern. And here's the unbelievable part. This pattern took 10 years to form, a full decade. There is no way you would ever spot this on a daily chart. And if you thought that was incredible, it gets even crazier. Here's a monthly chart for IBM. The major bottom in 1993 happened at almost the exact same price level as the bottom from 20 years earlier, back in 1974. 20 years. That support level held for 2 decades. That's not just noise, folks. That is market structure. Okay, one more example, just to really hammer this home. Take a look at Burlington Resources. See the rally in 1997? It stopped dead in its tracks. And where did it stop? At the exact same resistance level that had stopped the rallies in both 1989 and 1993. The market remembered that specific price level for over 8 years. When you see stuff like that, it really just brings you to this one central point, this one big question. After all that evidence, you just have to ask, who says charts don't have a memory? So this is all fascinating stuff, right? But the big question is, how do you actually use this? How do you make it practical? Well, there's a really clear, actionable framework for this. It's all about taking a top-down approach. You start with the big picture, and then you slowly drill down into the details. Here's the playbook. It's pretty simple. Step 1 is the macro view. You always start with a 20-year monthly chart.
This is how you find the main primary trend. Step 2, the intermediate view. Then you zoom in a bit to a 5-year weekly chart. This is where you analyze the more recent major swings. And only then, only as your final step, do you look at the daily chart for your short-term timing. You see? You start with the forest, then you find the right group of trees, and only then do you start looking at the individual branches.
So the big takeaway here is this. When we ignore these long-range charts, we are willingly throwing away a huge amount of incredibly valuable information. We're literally choosing to get lost in all that static instead of listening to the real music of the market's long-term memory. So I'll just leave you with this one question. Now that you've seen the forest, how are you going to change the way you look at the trees?